Hello everyone, this is Phil Yaeger and welcome to Accounting for Income Taxes in Financial Accounting. Now, I want to give you a review on this, and you have to remember that income tax expense on the income statement is made up of income tax expense current and income tax expense deferred. These two equal your total income tax expense that goes on the income statement. Now, first of all right, let's talk about the calculation of the first one. Income tax expense current. Well, this is based on taking your taxable income times your current tax rate. And that will give you a debit to income tax expense current and a credit to income taxes payable. Now, the thing you have to remember is this. They're going to probably give you the book income, all right, and you're going to have to reconcile to the taxable income. And the way you're going to do that is you have to know, all right, what items, first of all items of income are included in book income, all right? Interest on muni bonds, all right? Another one would be, for example, insurance proceeds from a life insurance policy, all right? But if you had to go from book income to taxable income, all right, you would have to take out the interest income on municipal bonds from the book income. You would have to subtract the life insurance proceeds from the book income to arrive at taxable income. And in turn, what do? Well, all expenses are deductible to arrive at book income. So therefore, any non-taxable expenses that are not deductible on the tax return, any expenses, all right, that are not deductible on the tax return, but which were deducted on the books, have to be added back to the book income to get our taxable income. Remember that. Now, one other thing with this income tax expense current, income taxes payable. A lot of times, companies pay estimated taxes. Now, they may ask you this. If a company paid estimated taxes, all right, what is our income tax expense current? Well, if it's asking for the income tax expense current, it's still just the taxable income times the current tax rate. But if they ask you for the income taxes payable, what do? Well, you take your taxable income times the current tax rate, all right, and subtract from the income tax expense any estimated tax payments that you paid in advance, and that will equal the income taxes payable. So estimated taxes only affect how much you actually owe the government. It only affects the income taxes payable. Now, the blueprint in our books, which is page 2L2, and by the way, all right, if you don't have our books, no big problem. But I want to talk about a valuation allowance account. Now, let me explain to you what a valuation allowance account is, all right? But, well, I'm not going to talk about it immediately, because now let's talk about the second component of income tax expense, income tax expense deferred. And this has to do with timing differences. All right. Now, there's an asset and liability approach when it comes to accounting for income taxes. All right. When we're dealing with timing differences. And timing differences is just a fancy word, which means what? All right. We may take one expense on the books. All right. Like, for example, depreciation. We'll take accelerated depreciation on the tax return, straight line on the books. Now, as long as we hold that asset for its total economic life, all right, initially, the accelerated depreciation will give you more income tax expense on the tax return. But if you use straight line on the books, straight line is going to give you less depreciation than the accelerated on the tax return. But about halfway through the life of the asset, our straight line depreciation starts to become higher than accelerated. But over the total economic life, at the end, the accelerated will equal the straight line. So That's called a timing difference. This time, all right, accelerated may exceed straight line, all right. If we use accelerated on a tax return, obviously, all right, we're going to have additionally lower taxable income than book, but eventually our taxable income will be higher than book. It's just a timing difference. But eventually all the depreciation expense will be the same for tax and book purposes. All right, now let's assume it's the year 12/31, all right, 2019. All right, and on our tax return, we are using accelerated depreciation, and our depreciation, because accelerated on tax return, is $300,000. All right, but all right, on our books, because we're using straight line, the depreciation is only $150,000. Now, the way you do this information for accounting for income taxes is this. All right, you have to determine what the timing difference is. Well, in this case, if we're using accelerated depreciation on the tax return and straight line on the books, all right, what's going to happen? At the end of 12/31/19, all right, our taxable income will be lower than our book income by $150. All right, now we make this assumption. If in the current year our taxable income is going to be lower than book income, when this reverses itself, what's going to happen in the future? Well, taxable income will be higher than book income in the future because of the reversal. And when you have a timing difference in the current year, which will cause taxable income to be higher than book income in the future, this is called a future taxable amount. Now, if you take future taxable amounts and you multiply them by either the future tax rate, when it's going to reverse itself, if known, or if you don't know the future tax rates, you multiply it by the current rate. But that will give you, all right, future taxable amounts times the current rate, or the future rates if you know it, all right, will give you what we call a deferred tax liability. All right, now, you're going to record that deferred tax liability at the end of 2019, all right, and what you're going to do is you're going to credit deferred tax liability, whatever it is, and the plug is to income tax expense deferred. Now, at the end of every year, you're going to do this. The income tax expense deferred is closed out to the income statement, but the deferred tax liability account stays open, all right, and each year you will adjust it. So if the end of 2020, our deferred tax liability balance should be higher than what we set up at the end of 19, then in 2020, you'll make an entry to increase the deferred tax liability, credit deferred tax liability, and you'll debit income tax expense deferred. All right, now, the next thing is, what happens if 2019, we have this situation?
Thank you for previewing the Yaeger CPA Review course materials. To learn more or to purchase the full course, visit YaegerCPAReview.com or click the link in the description.